Right, in this short video, what I want to do is go over just using Nadex spreads on the Apex Elite MVP system. The advantages, of using a spread is it can have defined risk. It always has defined risk, so you can never move your stop, and wipe yourself out. And it also can have better leverage, meaning you can put up less money. Depending upon the spread chosen, it could be much less in the future. It could be more, depending upon which spread you choose. But you could potentially use less money. In just about every single case, you can use less money in the simple fact that you can trade a smaller size. You can trade a tenth of a Russell future, meaning like $1 a tick versus $10 a tick. Now you can also do trades where, you can do 13 ticks. So you can do 13 contracts instead of either one Russell future or 2 Russell futures. So those are some of the advantages. This is a trade this morning from the Elite Trade Room on the Russell. Steve went in. He did this on futures. I asked him. I was like, "Did you do spreads or futures?" He did it on futures this morning. And anyways, he made 106 ticks on it, or $1,060 on the trade. Trailing it down, getting out when we were about 1.5 deviations down, and market's still chilling on out. But had a nice solid trade right there. But this trade also could have been done using a Nadex spread. A few details for you on how Nadex spreads work. So let's go up here, and what I'm going to do is I'm going to pull up the spread scanner, and I'm going to reset all my filters. Always learn in demo. You can't break it. Okay, so just start hitting the buttons and learning. And there is a spread scanner course right here under scanners. Spread scanner courses. It's right there. You can watch that course and watch the stop plug-in course. Okay, there's an FAQ section on the scanner if you have questions. Anyway, so we go down here, and we basically have exhausted all the spreads at this point. But earlier in the day, you could have chosen a variety of spreads. Some of the important points you want to think about is, how much it mirrors the market. Like, you probably don't want a spread that is 40 ticks off or 120 ticks off of the market, right? Because I'd have to move a whole lot before you make anything. These are just spread basics that you should already know. And so you want to learn that. You want to learn how to, put that together. But just understand that they mirror the market if they're close to the market. But if they're, if there's a big difference, 70 ticks, 18 ticks, 30 ticks, that's premium or it's out of the money. It can be some of these spreads are just way out, like right there. You can see the floor is like over here, and here's where the market's trading. So that's why it's so far out of the money, just because that's the floor of the spread. And it even tells you it's out of the money. It's only $5 risk, but it's pretty useless because the market have to move 17 points before you even got back your $5. So you want to make sure you are choosing the right spread, okay? Okay, so you can choose intraday spreads, or you can choose daily spreads. And I talk about how to choose the best spread in other videos, and we'll put those together for you in a little compilation. But ultimately, you want to consider how much time do you have, how low of a risk can you do the trade for, and what's the proximity. So you're looking at time, proximity, and then risk. Now, on the risk, the max risk doesn't actually have to be your risk on the trade because you can exit the trade before expiration. So just because a trade says it has, $300 in risk, doesn't mean you have to take $300 in risk. You could just be taking $40 in risk because you're going to get out of the trade if it moves 40 ticks against you. Goodness. Pardon me. All right. And so that's the above and below the market idea there. On every market, it tells you how the spread ticks in relation to the underlying market. So the Russell, like Nadex spreads tick in 0.1. The Russell ticks in 0.1, and Nadex spread has a tick value of $1. The Russell spread has a tick value of Russell future has a tick value of $10 per tick, and different markets have different tick values. The Nasdaq, silver, and copper all tick really slow. You'll make very little, but you'll also lose very little unless you're doing a lot of contracts. So they're good for a small account, a new account just trying to figure things out. Like where you may be risking, say, $40 on the Russell, you'll only be risking like $10 on the future. Okay? And you may make a little bit less, but you put up a lot less. So, it's just because of the premium, the way it works. You can mirror futures contract using multiple spreads. So use a scanner to find them. And go in and figure out what you want. I'm usually going to do I'm not going to put max risk because I don't care about max risk because of my account size. Because I'm not going to take on the max risk. I'll get out of the trade. Maybe you only have, $500 in your account. You may say, well, I'm not going to put on a trading if there's more than $100 risk. Okay? I'm not worrying about that because I don't want that to limit me from my best choice of the spread. I will go in and I'll say I want, an at-the-market spread. I want a 1-to-1 risk-reward ratio. And that'll immediately limit my spreads down. I could say maybe I want to sell. If I did that, it'd be like, well, here's the spread that's available. This one contract right here. Here's your sell spread. It's for the current hour, 2 o'clock. You got an hour and a half left on the trade. 13 ticks away. Okay, I'll take that trade. All right? Because that meets all my requirements. I prefer, in all cases, I will tell you, I prefer to have the widest spread I can get. Okay, because it'll move fastest, I can make the most money. If I only had a 7-point wide spread, well, this spread right here, think about this. We captured 10 points. 100 ticks. So you would have capped out the spread. So I don't like capping out the spreads. I like to keep making money. Now, what can you do? Well, if it keeps going, you can't just go to the 3 o'clock and do another spread. So you can take that one, max profit, great, go in, do another spread, go in, do another spread. So you can do that and just roll into another spread if you want to. I prefer to choose the larger spread and don't have to even worry or think about it. So that's a way to mirror the futures market, just get that wider spread. It could be the big master spread, or it could just be a daily spread with plenty of profit potential in it. Ideally 10 or 15 points or more. If you're using just the spreads. And when it comes up, it's pretty simple. You're going to go in, and you go, okay, well, let's just say we don't have one right now, but let's say we get an MVP buy. Okay, let's say that if it breaks 11.21 on the underlying market. And I go down here and it's like, okay, well, I want to buy, let's say I want a 1-to-1, or I usually put 0.5, by the way. 0.5 to 1, and I want it at the money. What do I got? Okay, well, here's a 415. I can put up $24 to make 44 on the one that expires in 22 minutes. I can put up 31 to make 36 when it expires in an hour and a half. I don't like that one, it's too short. So I have these are my choices here, and I'm buying, so I can just click the buy, get rid of the sells. Okay? But they are 6 and 9 ticks away. But that one's too short. Doesn't give me enough time to make any money. This one's a little further, 17 ticks. But 17 ticks is not that far on the Russell. Okay? A 1.5 points, not a problem. And so I'm really narrowed down to these 3 at this point because I want at least an hour for the thing to move, at least. And these have the exact same risk. This one has more reward potential, and it had the exact same break-even distance and the same expiration time. So if I could have, if the expiration time is the same, the proximity is the same, and the risk is the same, and I can make more money, I'm going with the one that can make more money. Now I have these 2 choices to decide, depending upon my account size, depending upon whether or not I want to use a stop, depending upon if I want to be able to take it to 4:15 or just have till 2 o'clock. Think about this. We're going into the lunch hour. Like this trade, right now we're looking at 1 o'clock. So, if there's only 81 minutes left, the market usually doesn't move a whole lot during lunch. So I might just be spinning my wheels by buying a 2 o'clock expiration. I may be much better off with that 4:15 and actually have some good profit potential. So we're only talking 7 more ticks to break even, about $20 more I got to put up. But now I have all the way till the end of the day. I don't have to be worrying about flipping back and forth, and I got tons of room in there to make money. So I can make basically 25 points of profit potential in that trade. So if I did 10 of them, I'd be putting up $500. That's about the same amount to do a Russell contract, but with capped risk on it. And, I can ratio it out. I can do 1 of them, I can do 10 of them, whatever I want to do. And we even put up here what the ratio is to a future. So 10 Nadex spreads equals 1 Russell contract. 1 Russell future. So NASDAQ and silver and copper, again, I want to remind you, it's not that they're bad, it's just that they're lower leverage. And so they're going to move slower on you. So you're going to be really upset if you're like, why am I making nothing? And to give you an example of that, right over here, we go down and we can see that the NASDAQ's ticking in 1 and that Russell is ticking in 0.25. Somebody's mowing. Okay, so anyways, but right here, the NASDAQ is going 1 and the, right here, 0.25. So if the NASDAQ on Nadex has a higher number, it's going to move slower. Like the NASDAQ future have to move 4 ticks for the Nadex spread to move 1 tick. Well, that's good if you're trying to have really low risk. It's bad if you're trying to have really high leverage, okay? So, that if you have a small account, you want low risk, that's a good place to start. Copper's the same way, silver is the same way, okay? If you want really high leverage, you got things like corn, soybeans, and the S&P. Why? They all tick faster than the underlying market. See how the underlying market ticks in quarters? They tick in dimes. So they move faster. So you actually get higher leverage on those. And pretty much everything else is equal leverage except for the FTSE and the DAX. They tick in 1 versus 0.5 on the future. So they're a little bit lower leverage, but not a lot lower. But that gives you an idea. I've just done a couple spreads and why you may not. You either may want to start with the tech in gold and copper, or silver and copper, or you may not want to start with them because they may upset you because they don't move that fast. You may want to start with corn and soybeans and the S&P because they move faster, or you may not want to at all because you're going to be risking more money when you trade them than you would if you're trading, like, say, a Russell contract, which is a little bit different than normal if you normally trade futures. And so if an entry comes up, let's say we have an entry to buy. We'll just throw the Russell back up here because that's what we were on to begin with. And we go to stop trigger. Let's say we're supposed to buy if the market hits 1120.4. Okay, let's say it's 1120.1 is the high of the E. All right, so I go 1120.4. Market offset, I'll say 10 ticks at most. And I'll say 5. I can say 5 ticks off where the market's at. But I can say no matter what, do not get me in higher than 11. We'll just say 22. Then I can say activate stop trigger. Now that's going to work for me. If the market hits 1120.4, it's going to fire my trade off. Okay? Now, if 3 bars go by, or 2 bars, depending on which rule you're using. So some people use 2 bars after the E bar, some people use 3 bars after. But when those 2 or 3 bars go by, if it has not triggered, then you're just going to say deactivate. Okay? Or if things oscillate, you get a new E. Okay, so you can leave it up there. Like maybe this is your spread choice right now. You already know it's your choice. I don't have to look at it. And unless the market flies way up, I'm not going to go get a different spread. So I can literally just keep this spread up here. It's the one I'm trading. If I'm going to buy today, this is the one I'm buying. And so then another one comes up a little bit later. Let's say, we get one that's, now there's a new E. It's done at 1120. Is like 1119.7 is the high of the E. So I can say, okay, well, I want to buy at 1120, no higher than, we'll just leave it at 1122. That's fine. 5 ticks above where the market is. Activate that. And then if the market hits 1120, then what's going to happen? It's going to fire my trade off. It's going to get me in. And I'm going to get to go long on the trade. So we'll see here. It may hit it for us in a second. It's really close. But that'll fire my trade off. It makes it a lot easier versus having to sit there and watch the chart and wait and wait and wait. I mean, like right now, we're waiting and watching to see if it hits 1120. Well, imagine having to have your finger on the buy button, waiting and waiting and waiting and waiting. So it makes life so much easier. And then, 3 bars go by, whatever, you decide not to take the trade, boom, bid deactivate. Okay? Now, you get in the trade, and you're long, so let's just say we bought the contract. Okay, so I'll switch back over, I'll say, yeah, let's go ahead and buy this one. Okay? Or it was so fast I had to hop in right away. Whatever. Then I just hit the stop watch icon right there, bring it right up, it'll bring me right into the stop screen. If it doesn't, if you hit the the stop icon or the stopwatch icon. There's two different ones. Stopwatch takes you right to the stop. And now I'm going to trail it. My trail, let's say my trail is, let's say it's 20, I don't know, let's just say it's 20 ticks back. Okay? Let's say I got filled at 11.20, because I basically did it. I got filled at 11.20.2. And now I want to get out of, let's just say if it hits 11.18. I'm just giving you a random number right here. But it's 11.18. But don't get me out. I mean, the bottom of the thing is 11.16.5. So, you know, at what point is it not worth getting out? Well, if it's below 11.17, I don't really need out of the trade. Right? So, I'm just going to put like 5 on there. Or I may go, you know what? 11.16.5 is my floor. My stop's at 11.18 for another $15. I'm not going to use a stop. So I may choose not to even use a stop loss because it's only going to be another $15 of risk. Now if the thing goes way against me, it can still come back and I can be profitable on the trade. So I'm at a great point to place a buy because my risk is so well defined right now. And let's see here. So, but anyways, we got yeah. So either you can use it, or if you wanted to use it, you just activate it. And if it got down there and submit your order at 11.18, when the market hits 11.18, it'll submit your order to sell 5 ticks below where the bid price is, but it won't submit it any lower than 11.17. Now, again, the floor is 11.16.5. I'd more likely use that if, let's say, the floor is like 11.10. Then I may be more apt to use it that way, where I actually put that worst limit. The floor being so close, I'm going to be like, you know what? I'm using spreads. Let's not do that. Also, I can then explain it. It'll explain it to me. When the indicative falls to 11.18 or less, automatically submit a sell limit order for one contract at the maximum of the following. A limit of $5 below the current bid price. So back to me, whichever's higher. $5 below the current bid price when bid size reaches 1 or more. So making sure there's actually a bidder offer size, some liquidity. Or a limit of 11.17 when bid size reaches 1 or more. And stop looking to submit the order at 1:58 Eastern Time. Okay? Which is a couple minutes before it expires. Okay? So pretty simple, but that's how it works. And that was just to give you like one random example. So we put that one on there. We got this one on here. So like that one's at 11.15. That's still pretty close, but that might be a little better example of, you know, when to put a stop in and not risk another $20 on the trade. So that's how you get in. That's how you get out. You can also just exit the trade. You know, if you got a pending working in there, you can just top out of the trade. And you know, I talked about advantages of short-term spreads, less risk. Advantages of long-term spreads, a little more risk, you could say, because you probably won't be using that stop unless you had a big move like today where the market flew down. And we got definitely a pending MVP reversal over here to this massive move down that might pop up. Basically, if we close up above that line over the next couple bars. But that's really all there is to it. It's just a matter of just got to look and see what makes sense, what's close to the market, what has the right time that you want, and what has an acceptable, you know, amount of capital that you want to put up. And would you prefer to do a shorter term, lower risk, no stop loss, but may end up burning out the premium in it because it didn't move fast enough? Or would you rather have maybe another few ticks of premium but have all day for the thing to move in your favor and not have to worry about is it slowing down or speeding up or whatever? If you have any questions about that, let us know in the forum, and I will be glad to help you out.